Kia ora tātou, and welcome to this discussion about all things to do with an important topic, money. Today we're going to be talking with a group of learned experts, a group of great people about starting businesses, about investments, about planning for our future, whether that be in a career sense or in a retirement sense, and about growing wealth and security for our whānau, for our lives, and for the things that we love. So the first thing I need to note in a discussion about money is that none of what we talk about here is investment advice or financial advice. Talk to an expert in real time if you want that kind of advice, and this isn't constituting that. Second, I just want to introduce the members of our panel. So we're joined here by Jen Baird, CEO of the Real Estate Institute of New Zealand, by Liz Coe, a financial expert with particular expertise around planning for a fantastic retirement, by Billy Jo Hohepa, a business owner and entrepreneur, also an investor in her own right, and by Stuart Anderson, an investment advisor with Craigs. So kia ora tātou, welcome to the wonderful panelists, and thank you for joining us. We're going to start with a rapid fire roundtable, digital roundtable questions, so that people can understand a little bit about you and your mindset on money. So the first question, and I'll go around the group in the order we just did there, is if you were gifted $100,000 tomorrow to invest as you chose, what would you do with that money? And I'm going to start with you, Jen.
I love this question. Thank you for giving it to me. I feel like I've spent ages dreaming about this. So after many, many hours of careful thought, I think probably what I would do is put half of it on my mortgage, so 50 grand on a mortgage. And then I think I would back myself to buy a nice car or some really nice art, because life's short, right? You've got to have a bit of a balance and enjoy yourself. But probably what would happen is that over the following 12 months, all of the other 50,000 would end up on my mortgage as well.
Great answer. Honest. Tying strongly into the real estate platform there. And Liz, what about you? $100,000 tomorrow, what would you do?
It sounds like a lot of money, but actually it's not. For me personally, I'm in a stage of life where I'm decumulating wealth. And so what I would do for me personally is set up probably an endowment fund with my local community foundation for charitable purposes. But for anybody else who's not in that stage, for someone younger, I would say the first thing to do is to pay off debt, and then set yourself up a decent emergency fund, and then either pay off your mortgage if you have a home, or if you don't have a home, save up, use that money to as a deposit for your first home. So that would be my recommendation.
Excellent, good. Your own situation and others. And Billy Jo?
Yeah, I think my husband would love a Dodge Charger, but the price of petrol, right? I would say absolutely no, because I'm in a business and I'm getting return on ad spend at around 3 to 4 times. I'm sorry to say I'd have to spend it on my business, and Mr. Facebook would get all that money. But yeah, I would put it back into my business.
Excellent. That's a very immediate investment. And Stuart?
Yeah, thanks, Matt. It is a great question. And it's easy to put your business hat on or your academic hat and say, for example, in my line of work, I'd invest a lot, and look, I would be investing a decent amount of it. Obviously, with markets pulling back in my world, it's a great time to be having spare cash flow to invest. But as Jen said, look, life's about balance. I'd obviously want to do something nice with the family, but I also am involved with a number of philanthropic organisations, and my family have a little giving program that we do every year as well. So we'd allocate some to that, some to have a bit of fun with. But I would like to get my hands on a decent chunk of it and invest it into the markets over the next couple of months.
Yeah, brilliant. Interesting. Everybody's got quite a wide range of approaches there, which probably sets the scene for the rest of the discussion, because of course people watching this will be in a range of different situations, personally and professionally as well. So I am going to dive into a series of questions here. Some of them might apply generally, some of them will apply to, you know, just one or two of you, depending on your sector, as we go through over the next 50 minutes or so. We'll wrap up within the hour. Can I start on a perennial New Zealand wealth creation or investment favourite, which is the real estate market? And here, Jen, I think you're the right person to start with. For people looking to get into the real estate market, we've all been looking at the news and watching house price affordability stories. They're a sort of mainstay of media in New Zealand. What would you advise for somebody to get onto that ladder?
Well, I would say do your homework. And then if it's the right decision for you to have property as part of your portfolio, or you want to own a home to live in, you just got to get in. There is a lot of media around, and regardless of which way the market is going, it is, like you say, one of those conversations that New Zealanders love. We love reading about it, we love talking about it, and of course everybody's an expert. But there is no crystal ball. And so we never know where the top or the bottom of that market is until afterwards. But really it's about your own personal circumstances and what's right for you and what's right for you when. So really it's kind of getting a lot of information, really knowing what you're getting into. I think that actually is the same as any other investment. It's about having your information lined up, talking to the right people. At the moment, there's so much data out there. There's numbers coming at you from everybody every second day in the media. Think about the data that the Real Estate Institute puts out. Our data is last month's unconditional sales, so a few weeks old, potentially for some of them. Everybody else's data is settled sales, so a month or so older than that. The people that really know what's going on in the market, people that know what happened at open homes on the weekend and what sold in your area last week, are real estate agents. Talk to them. They know what's happening right now.
Fantastic. Interesting. Liz, did you have any views on that one as well?
Look, I think it's really important, if you're aiming to buy a home for yourself or rental property, to be in a really solid financial position, because the key thing at the moment is being able to borrow money. And so any lender will look at your track record. They'll look at your spending patterns, whether you're able to save. So you really, really need to focus on spending less than you earn, demonstrate your ability to save, to be in a strong, solid position. And particularly if you're thinking of buying an investment property, you might need to prop that up a wee bit out of your income. So you need to be able to withstand that. You don't want to be in a situation where you can't make your payments and you're forced to sell up, especially if it's in a declining market. So just be in a really strong financial position, have some emergency funds, have good savings, good track record on your spending habits, that kind of thing. That will stand you in good stead.
Thanks for that. And I'm going to stay on that one for a moment, because you just raised the concept of investment properties. And, for some, this will be the challenge of getting onto the property ladder as a first-home buyer. But how do you think of investment properties, a second home, a third home? What strategies might you consider if you're looking at investment properties as part of a portfolio for people who are in that situation? And then might link back into Eugene as well.
Well, I think that property is a great way to grow wealth, because it uses leverage. In other words, it uses other people's money. The key thing is to manage your cash flows, because that's where people get caught out with property. So, leverage works both ways. It can leverage you way up, or it can, magnify your losses. So you absolutely have to focus on cash flow. And so most of the successful property investors, that's what they do. You don't want to get caught short. So it's about, I'm a big fan of property. I've been investing for 20 years in property, and I know how well it works. But you've really got to do your homework to know the numbers, to know just how it ticks, and have a well thought out strategy. What type of property you want to invest in, what geographic area. Make sure you get a really good team of experts around you, accountants, lawyers, what have you, to advise you as you build your portfolio.
That's brilliant. Jen, what are you seeing in the investment property side? It's obviously been a tumultuous time.
Yeah, I mean, I would say everything that that Liz has just said, absolutely support that. But also, I think, buying the property is the straightforward part when you're a landlord. A lot has changed in that space in the last few years. There is significantly more regulation for landlords than there has been for, forever. All of the healthy homes regulations, and then obviously tax changes that came out at the beginning of 2020, I think it was. Gosh, I was going to say last year. And having a good property manager, those sorts of things are really going to make that process a lot more straightforward for you, because it's, when I think about housing in New Zealand, it's a big challenge, right? And actually more and more people are going to be renting for a long time. And so private landlords have got a really important part to play in solving or helping to solve that particular challenge for New Zealanders. But it's important that you're not just seeing it as an asset, that you recognise that there are people that are going to live in that house and that you have responsibilities to them as well.
Yeah, it's a really important point. And I might bounce across to you now, Billy Joe. I think property investment played a start in your business investment career. So I want to move into business investment, but can you just give us a little bit more of a background about how you got going in your investment and business career?
Yeah, well, so my husband and I, we ended up buying our first home. And when I say home, it was a 1.5 bedroom townhouse in Wellington. And that's what we could afford, right? We couldn't afford a big home on its own standalone property. You had to either buy a unit or something smaller, and that's what we did. But we wanted to get into the property investment space. And so we ended up going to a lecture with Lisa Dudson, who's huge in property. And we ended up being there for 2 hours, bought her book, read it in 2 days, then 6 weeks later bought our first property, and that was basically off the equity on the home that we had bought, and it had increased by $50,000 in 6 months, and so it was quite a hot market. But on that point of property, I was just at a home on the weekend, and they're wanting $250,000 with a $320 a week return on rental. So I still love property. I think we, as landlords, have a responsibility to provide homes that people can't afford. And yes, I'm still looking.
Still in the market.
There are bargains to be had, and I think there's a lot of investors that are getting rid of a lot of their homes. So it is a good time. Interest rates are still quite low. I remember we bought ours and it was up to 9, even 11%. So you can still get in, maybe get a 3-year mortgage. But I think just get on the ladder. Anytime's a good time, I say, but your expectations have to be lowered, and it is a do-up, and that's part of that owning a home journey.
Yeah, and it is. You're right. It is a journey with a lot of different people involved, whether they're on your team or the people living in the property. So,
and I think when you get into property investment, you should be the manager. Like, you should take care of, that's your investment. So make sure you know who your tenants are and they know you. And every 3 months you go and check on your property, because it is your it's your baby, right? And you make it known that is they need to take care of it too. You will take care of it as well. That's kind of your responsibility. But both of you have a responsibility to take care of that asset.
And so how did property play into the launching of your business? And I guess I put that in the context of what risks did you have to take financially in order to start in your business career, you as an entrepreneur?
Yeah, I suppose, well, we were lucky enough to get into property investing before we got into business. So I'd been a journalist for 20 years. So business wasn't it was a dream, but it became a reality after I put in the investment in doing an MBA. So got the tools and then wanted to use them. But because we had made that investment into our first property, we were able to sell it and get $100,000, which became seed funding for our our first business, our second business, which is B-Day, our company we have today. So hugely, I mean, I'm not a trust fund baby, wish we were, but we as a whānau had to pull in our resources, and a lot of people have to. That's the reality. Many are bootstrapped.
Yeah, and I can imagine that those are, it suddenly gets a little bit more real when you're putting an asset that you've worked hard for up as collateral and getting things going.
Yeah. And in terms of the risk, I think we always, I've learned a really good framework. It's called the SWOT analysis. So you look at, what are the strengths of your business, what are the weaknesses, the opportunities, and what are the threats? And if you really glean down on each of those categories, you kind of work out, hey, I think I've got something really good here. It's going to be tough because people don't know about our product and what it does. It's going to be a journey, but I think if you back yourself, and a lot of it is purely belief, there's a whole lot of theory, but there's a whole lot of just belief behind what you're doing and what you're getting to in business, but it's not a quick win. That's it. She's not going to Las Vegas.
No. Well, I was going to go to you, Liz, actually on that, and then I'll pop over to you, Stuart, on a different asset class, but different investment approach. But Liz, when you think about business, we hear Billy Joe talk about risk, and this is it's not a guaranteed win, and risks can sound great when they come off and they all work out fine. It's what movies are made of. But the other side of risk is, of course, it doesn't always come off. When you talk to business owners, or you consider your career, how do you think about failure and absorbing failure, dealing with failure, courting failure? How do you think about the role of failure in a wealth creation over the span of a career?
Well, I think this is where a lot of entrepreneurial people can come unstuck. You have to plan ahead for failure. And we don't want to necessarily focus on failure. You obviously want to focus on success. But I always encourage people to have what I call a safe deposit box. And I don't mean that literally, I mean figuratively. So you don't go all in as if, like when you're playing poker, you don't put all your chips in. You leave some reserve. So if things do fall over, you've got something to build from again. And, you don't look very far to see, like people who are truly entrepreneurial, they're often, boom or bust. Donald Trump's an example, I guess, isn't he? But those sort of people take a lot of risk. And so there is always that possibility that things won't work out. So you've just got to have that in the back of your mind, that you say, okay, if this doesn't work out, what's my plan B? Have I set enough assets aside that I can rebuild? Because you don't want to be wiped out, so badly that you can't start again. So yes, look, the people who are seriously wealthy are the ones that have taken a lot of risk. The ones that are most successful are the ones that don't risk absolutely everything. So that's how I would really summarise it. So be prepared to give it a go, but do it in a kind of a safe way. Do your homework.
Yeah, reflecting on that, it sounds like the safe deposit box almost a degree of conservatism or carving off a fallback plan actually empowers you to take more risk, because you know the level of risk you can take.
That's right. And it also keeps your other family members happy as well. I've seen, marriages fall apart because, one person wants to risk everything and the other one's a lot more conservative. So, by having that safety net, you're bringing other people with you, especially, a spouse or a, close family member. So, it's a good idea to, just have that safety net there.
Thank you. It sounds like Billy Joe might have been through that, I can imagine. And can I, Stuart, I'm going to come to you in a moment on cryptocurrency, but you also talk a lot with people who are considering how to spread, I guess, a portfolio of investments and so on. So just on that last point that Liz raised, what kind of conversations do you have when you're in discussion about how to manage risk levels and so on?
Yeah, look, Matt, it's the biggest part of what we do when you're setting up an investment portfolio is to understand an investor's risk tolerance. So a lot of that is understanding aspects of their own asset base, so figuring out what assets they already hold. Are they already heavily exposed to property or forestry or farming, etc. And then just going through a series of questions to really get our head around what their general risk tolerance is like, what kind of moves in the market can they tolerate, also understanding what their requirements are. How much income do they need off their portfolio? What certainty do they need? Do they have capital projects coming up? Are they planning on buying a batch or another property in a few years' time, and therefore need a degree of certainty around that? So there are lots of questions that frame the development of a portfolio, and what that drives is what we call an asset allocation. So how much should they have in shares? How much should they have in property? How much should they have in fixed interest or bonds? And the different degree that you have in those assets is depending on the answers to those questions. If you need much more certainty of income or capital, you have a reasonable degree of exposure to fixed interest. If you are in a position in your life where you're looking to try and grow your capital base as much as possible, and you don't have any upcoming capital requirements, maybe you're younger and you have good earnings, then you can focus more on the growth assets, your shares and your property. So there's a lot to discuss, and it's very personal. So every client will be slightly different. We don't believe that everyone just fits in these boxes. And it's something that's also very fluid. So as you go on over the years, your risk tolerance may change. And it might be because of personal circumstances, or it might be because a market event flushes out what your true risk tolerance is. So, for example, with what's happened in the past couple of months in investment markets, clients that thought they could cope with risk quite comfortably, we're starting to find that maybe their risk tolerance isn't quite what they thought it was when they go through an actual event and their money's invested. So lots of questions around that determine what a portfolio looks like. But just touching on that last question as well on failure, that's something we spend a lot of time analysing as well. All companies come under pressure and have situations that are tough on them. And we put a lot of credence on the quality of management, on how they deal with those challenging times. So when we analyse a company, we're looking at the company, but we also look at the management and how they cope with bad times. And that to us says a lot about that company and that management team going forward. Classic example I always remember back in the early 90s, Michael Hill, was doing really well in the jewellery sector. And they decided to try and diversify and get into shoes. And they actually opened Michael Hill Shoes as an add-on to Michael Hill jewellery stores. And it was a disaster. They really misunderstood the market, and that part of the business started losing money very, very quickly. But the quality of management to recognise that it got it wrong, cut it, focus back on what their core business was and what their strength was and recover. To us, that was a really good sign of good quality management. So you can learn from failure.
Yeah, really, really interesting. And I guess if we're never failing, it would imply that we're probably not taking sufficient risk to get to an optimal outcome. We're playing too far within the boundary if we would never risk failure.
Yeah, and I think different cultures look at failure differently. I think in New Zealand, we're all a bit, you feel a bit bad about if things go wrong. And in American business, they almost wear it like a badge of honour that they tried and failed, but at least I tried to really, go for it, and it didn't work out, and I picked myself up and carry on. So it's interesting how we view failure. Yeah.
Yeah, there's a lot of psychology and culture in there. All right, so speaking of psychology, cryptocurrencies, and there was a question that we had here, which I think is almost impossible for you to answer. Are they a solid investment or are they a fad? And I think the future's the only way to find out the answer. But what's your take, I guess, on cryptocurrencies, digital currencies, and the movement towards investments in those, and even the volatility in the last few weeks? What are you seeing on the analysis there?
Yeah. So look, I actually think the question of is cryptocurrency a fad or something we should take seriously, and is it a good investment, are quite separate. And I think that's where people get a bit unstuck. They think they need to be in this cryptocurrency market because, well, that's apparently what you should do and it's going to be the future. But look, cryptocurrency and digital currency, blockchain technology, from a technology point of view, look, that may develop into something that becomes the future. And you're right, we're only going to know that with the benefit of history. But we've seen lots of industries where that's happened. You look right back to the combustion engine automobile. A lot of people thought that was ridiculous and would never replace the horse and cart. And it became one of the biggest technological changes of our life. But from an investment point of view, there were something like 80 odd automobile manufacturers in the States in the 1930s, I think. Well, that got whittled down to about 4 by the late 90s, and most of those were owned overseas because they were all going broke. So what is a great technological change and could be a huge influence doesn't necessarily mean it's a great investment. And the other issue is that cryptocurrency, like any, we would class it more as a commodity type asset that people are buying, basically hoping that tomorrow someone is willing to pay a bit more for it than they did. But that's no different to a lot of metals like gold or silver or standard currency. It's speculating on an asset, and we don't really view that as investment. Investing to us is buying something that has the power to generate a return in its own right. So buying a business or a property where, the rent from the property or the dividends from the company can generate that return regardless of what the value of the asset's doing. So I think people need to understand really what they're doing. Are they investing or are they speculating on an asset?
Really thought-provoking. Thank you. I'm going to stay with technology, but link it back into your world, Jen. So there were questions here about what opportunities or disruption blockchain might bring into the real estate market. But more broadly, what are you seeing in terms of disruptive trends from technology as it relates to the real estate market?
A lot. So interestingly, I was in real estate for 10 years and in 2017 stepped out and came back in 4 years later. And I just can't believe the amount of technology investment that has happened in this industry in that 4 years, particularly around COVID-19. Real estate, like every other industry, had the handbrake pulled on the 23rd of March 2020 and had to adapt really, really quickly. And so a lot of firms invested enormous amounts of time and energy and money into their technology. And it has just come along in leaps and bounds. I mean, the really obvious and most public one would be online auctions and how that, enabled enormous amounts of real estate to be transacted over the period of the pandemic. But yeah, one of the things that we've been talking about a lot is what is the industry of the future and how do we start thinking about what that is going to look like for real estate agents and for New Zealanders who are looking to buy and sell real estate. So we partnered with the Real Estate Institute Australia and did a piece of work with the Blockchain Innovation Hub at RMIT in Melbourne. On exactly that. What is the opportunity in this space? And, it's interesting how we tend to, it's really early days in this technology, and we tend to put blockchain and cryptocurrency together as almost as a single thing. But, I think that the crypto piece is it's the sexy, interesting piece. It gets the media attention. In fact, there was some recent media about a property that you can buy in cryptocurrency. There's actually been recently, I think, a deal that was half done in Bitcoin. So, it's starting to become something people are thinking about in New Zealand. I, of course, bought Bitcoin when it was $68,000 a coin. So when it's $1 million, I'll feel better about how I feel about it right now. But I think, like Stuart said, it's speculation. But I think the underlying blockchain technology, if it becomes the internet of the future, if it really becomes the kind of technology that we use in our lives in general, that is when we'll see the disruption. I think in our world, there's a thing that you have to go through when you do a real estate transaction that is part of the anti-money laundering legislation in New Zealand. I look at that and I think that is just credentials. If I can own my own digital credentials on a blockchain, it's completely transparent and immutable, and I can be in control of that. I can just give them to you. I don't then need a third-party AML provider to do that. It's those kinds of things that, seem like little pain points, but when you take cryptocurrency away and think about the actual use of blockchain, it's those sorts of things that I think, in the short term will make that difference. But I think we can't, if this ends up being a thing like the internet was, I think we probably can't conceive of what life in a blockchain world will look like just yet.
Yeah, the march of time is never kind to our the inside of our previous selves. It's
I think one of the things that is quite interesting is in terms of it opens up decentralized finance and the ability for fractional ownership of assets like real estate. So if we start thinking about conversations around affordability, you might not have 10 friends that want to go 10th in a property, but you might be able to find 100 strangers and have a fractional piece of property all over the world potentially, and that really changes the game for real estate and for property investment.
Yeah, that's very interesting. Can I'm thinking then slightly, thinking of the concept of time then and how we consider investments. Might pass back to you, Liz, for a moment. When you look over, say, the next 20 years, are there any industries, sectors, asset classes that you think are particularly attractive to invest in? And then more broadly, how do you think about the changes, and you referenced this a little bit with the $100,000 question to start, but how do you think about the changes in the kinds of investments you might make over the next 20 years of anybody's career, depending on where they are in their life journey?
Okay, well, I think the theme going forward, 20 years, that's a long time. Who knows what the world's going to be like in 20 years, whether we'll still be here, even if, depending on what Putin does, But I think, the big theme for me is environmental sustainability. And if you look at, there is an absolute growing trend for people to put their money into businesses and industries where environmental sustainability is a key focus. So that's where I think you're going to see a lot of money is heading down that track. In terms of other sectors, I think we've still got the baby boomers aging, and I think there's going to be a lot of in terms of healthcare, there's going to have to be a lot of innovation and investment in that particular sector. You've got your standard ones of infrastructure. That's always a good standby in terms of solid things. But technology, who knows where that's going to go? We all know that the rate of change in technology is just exponential. So over a 20-year period, there'll be things that develop that we, are just beyond our comprehension right now. So, but I think, with those kinds of things, as we were talking about before with Bitcoin, they tend to be more on the speculative end of things rather than core investment. And I think, so where they belong in a portfolio is perhaps at the sort of the dabbling end. They're the sort of things where you might want to put your toe in the water and have a go. And I'd certainly say that about things like Bitcoin or NFTs, I should say. They're the sort of things that you might want to dabble in just to kind of learn about and see how they go over time, but you wouldn't want to necessarily make them a core part of your investment. So you always be keeping an eye on the technology space in terms of, that's where you might get, you might strike it lucky and find that one thing that's going to make you a serious lot of money, but it comes along with high risk. So it's always, better with hindsight to see, the big winners. It's really hard to pick them in advance. But I certainly think there is a really rising trend, in this whole what we call ESG space. Ethical investing, there's going to be huge pressure, I think, going forward on particular companies, but also industries to really take that on board. And the ones who are going to attract the funding will be the ones that do take it seriously.
Thank you. And strong theme there. Links back to what you said earlier, Stuart, about essentially having a degree of balance across your asset allocations and thinking about different risk profiles when you go into something, depending on what stage you're at in life.
Yeah, and even within asset allocations within the asset classes, having a degree of diversification, and diversification is such an important thing across any form of investing. Not having too many eggs in one basket, because you just don't know what the future holds. You can focus on core fundamental sectors, necessities of life, food and energy and healthcare, and you would think that over time you should do well. But yeah, technology is a space that we know is going to become more important over time, but we don't know exactly who the winners will be. So having a decent spread of coverage, and as Liz said, we call it thrill capital. So we tell clients, look, if you want to get in something that's a bit different, call it your thrill capital. But you ring fence it. It's a small part of your portfolio, and we'd be quite disciplined about how much exposure you have to those types of sectors.
That's a great term. I'll use that. I might link down to you, Billy. Joe, sorry, down you're sitting just below Liz on my screen. Liz,
the old thrill capital, I like that.
So Liz mentioned, if you were going to choose, I guess, mega trends, then the move towards environmental sustainability is clearly one. You've taken a career turn into business ventures linked to environmental sustainability. Can you talk? Well, I think probably it's appropriate you can do the shameless plug for your business and your product, but I know you've got a huge mission. And also just how you have transitioned into thinking about business as a means to have impact as well as create wealth.
Yeah, well, we launched our business late 2018, but we registered in 2019, and it was literally born out of the vision for sustainability. So my company's B-Day, we've created a wet wipe alternative. So it's a natural foam that pumps onto toilet paper or tissue and turns it into a flushable, cleansing, gentle wipe. So we got that visual there, everybody. So as we know, wet wipes are being used for hygiene needs down there, and more people are flushing them, which is creating huge damage across the wastewater infrastructure and also for the environment. How I came about it, I was actually at Waikato University studying, and I came up with the concept then. So really, by the time we launched the product, it really had 20 years of R&D. And it wasn't until my kids kind of changed the formula to really what it is today. But I absolutely agree, Liz. It's a global movement, the whole sustainability for products and thinking about, it's not only the bottom line, it really is a push and a move and a conscious movement for products and the way we do business to limit our footprint, whether it be carbon, whether it be pollution, plastic. So, we're in our 4th year of trading. I'm so proud of where we are today. We are still trading, and I still believe we're in a startup phase, just because, with COVID 3 years taking us out, it's really kind of limited our ability to get overseas. But there's a real movement in that space. So we're at an exciting time. We're looking for investors. Put that plug out there. But I think we've gone through our lots of failures, and it is a test, but it's been thrown at us because we've been through a worldwide pandemic and still going through it. But totally love the journey, but it definitely is about sustainability. And I'd like to also say, like in 20 years time, definitely around the wellness space, I think we're becoming more mentally drained and kind of psychologically damaged, right? And we've got to say these things that sit right in front of us are just, it's creating a different wairua, and I think that's that space where we're going to have to really find, we've got to have time off devices, really, and that's going to be hard because we've got a whole generation that are just glued to devices. But definitely wellness, food, energy, for us to really think about as a nation and in that innovation space.
Which is a huge thing here, at the university, at the Waikato Management School. We talk a lot about empowering people to grow thriving businesses, but those thriving businesses they sit within a thriving society, and they have to contribute towards that. And that thriving society sits within a thriving ecosystem, a thriving natural world. And we do see that you've got to create value across all those realms. You can't purely just trade them off against each other. I'm might stay with you there, but others would have a view on this. We often hear a little bit about the need for New Zealand Aotearoa Inc. to become more productive, and there's a whole bunch of different ways into this. But when you look at our economy, this leads into wealth creation and investment certainly as well. What kind of startups do you think we need, or what kind of investments do you think we need as a country that are opportunities for individuals to invest, but also areas that we as a nation should be investing in to grow wealth and productivity?
Definitely ones that grow GDP. So have that export. We need to be exporting to make money. So anything that has kind of a global lens, that is unique, that is licensable, that we can really distribute. Tourism numbers are down, so we can't really sell to tourists at the moment. So it's definitely, we've got to look to overseas, and whether it's in technology, but we've also got to be mindful. We've got to maintain our IP and lock it up, because that is so unique to Aotearoa. So it's a tricky balance there.
No, that's right. And anybody else have strong views on that one? Otherwise, keep going.
Yeah, look, I think, and it's interesting, I was talking to some people not from the mighty Waikato this morning, and trying to give them a bit of an update as to, something we see locally all the time is that people not from this region still associate this area with being mostly agricultural based, or, the old cow town. But, the development of technology businesses, especially out of Hamilton, has been staggering. Certainly from what I've seen in my time here in the last 25 odd years. And that sector is such a powerful sector for New Zealand, because it is, as Billy Joe said, you talk about adding to GDP, technology businesses are huge with regards to the margins they can create and how quickly and easily they can expand overseas without the need for massive physical infrastructure. So I think locally we're doing a great job at diversifying away from, the rural economy will still be our backbone, but I think, this region is so much more than that nowadays, which is great for New Zealand.
Yeah, brilliant. All right, I'll ask a couple of tactical questions for those that are thinking about how to grow their wealth and how to go about it. And the first one is probably for you, staying with you, Stuart, and also Liz. I think you might have some views on this. So people are thinking of investing, do it yourself online. There's plenty of options for people to go and become traders on the phone, on the sofa, or using a broker. What do you think provides the best return and a holistic sense of return risk of the whole piece? I suspect I might know where you go, Stuart, but
you probably would. But look, it's horses for courses. I guess the main difference to really understand is your ability to do the research and the analysis yourself versus getting someone else to do it for you. Things like Hatched and Sharesies, etc. online, they've allowed people to, on their own, have a look and start experiencing the world of investing and doing it for relatively small amounts of money, which is a positive for people starting to build their knowledge overall. But I guess what we find is that one of the biggest risks to investing is actually people's emotions. There's a great book written by Benjamin Graham called The Intelligent Investor in the 40s. And the lessons he tries to instill in investors are still so pertinent today, that the biggest risk to your portfolio is yourself. It's not so much about the things you invest in, it's your own human behaviour. And markets can be driven by fear and greed very much in the short term, and that leads to people making mistakes. And the benefit of a full service investing firm like us is our job really is as much, part of it's picking the right investments, but a huge part of it is making sure clients don't make human mistakes and let their emotions overtake sensibilities. And we saw a great example of that, when COVID first hit in 2020, and a lot of people that had DIY KiwiSaver funds, etc., thought the sky was falling and immediately shifted their exposure from maybe a high growth portfolio to a conservative portfolio, fearing the worst. Whereas if they were long-term investors and had plenty of time, the best strategy would have been just to wait it out and in fact try to chip away and add to it as markets were low. Markets rebounded very, very quickly, and before they knew it, markets were above where they'd exited, and then they were stuck in a situation of not really knowing what to do. So, yep, great for people having a bit of a play and starting to develop their knowledge, but you've got to be wary of not having the expertise and skills to do it properly.
Excellent, thank you. And it reminds me, I just listened to a very long interview session with a guy, Morgan Housel, I think, who's written a book recently called The Psychology of Money, and fascinating. It's on my purchase list, because the way that the emotional side that you talked about, and the degree to which you think you can absorb risk when risk isn't happening versus actually going through the experience, and what decisions you make turn out not to be the ones that you promised yourself you would make when it wasn't happening.
Yeah, I spent half my time being an investment analyst and advisor, and half my time being a guidance counsellor and psychologist to clients. It's a fascinating blend. Yeah.
Excellent. And Liz, have you got any views on that, about how to think of doing it yourself and using advisors or brokers specifically?
Well, I think you need to decide if you're going to be a speculator or a long-term investor. There's nothing wrong with having a dabble yourself if you want to try your luck on a few investments. But for the long term, the key driver of return and risk is asset allocation. And you need to be in a diversified portfolio, and really understanding asset allocation and the art of rebalancing your portfolio. It's not something that your average person knows a lot about. And that's where your advisor can really add a lot of value, is in terms of advising you on that asset allocation. Honestly, you find, stock picking adds a small amount of value to a portfolio, but the key driver is, how much you've got invested in shares versus property versus fixed interest and cash, and that's the thing to really get right, and which you need to manage over your lifespan.
Really interesting. All right, I'm going to stay with the tactical, practical side. And Jen, for those engaged in the national conversation about property investment, what are you seeing in terms of locations and also types of investments, or that might be current or it might be recent? What have you seen work and what have you seen go wrong in terms of people investing in a property? Could be a town in New Zealand that's working. It could actually be something, Billy Joe, you raised. You want to be in that place doing the inspections yourself. That of course works if you're proximate, not so easy all the time. And it could also be the types of property. Are you seeing people invest in units and apartments, newer, older, townhouses, larger properties? What have you seen work and fail?
I feel like my answer to all of that is yes. All of that. I just think it's so dependent on what you're into and what you're looking to achieve and the kinds of properties that you understand. And, I just think about, the question about even where. I would always say buy in a market that you know. So for me, I've lived in Auckland, I've lived in Hamilton. So those are markets that I would buy in. If I thought that there was property in, Taupo, that would be useful, I would make sure that I did an enormous amount of research to really understand what was going on in that market, because it's not a space that I know well. I don't know where the good areas are. I don't know where tenants want to live, where the schools are, all of that sort of thing. And so it really comes down to, I think that's been touched on, really understanding why you're investing, what that property investment is all about, really is the point number one. Is it really just about capital gain, and are you looking to buy somewhere at the bottom of the market and hope that the property market goes up? Make sure you know that market in particular is underpriced. And in order to know that, you really have to dig under the hood. That's not something that is on the front page of the paper. These are things that take years to understand in terms of the detail around different markets. It's kind of like, the different types of the different shares and the different asset allocation. Buying commercial property in Tokoroa is very different to buying commercial property in Nelson. And which market is right for you? Probably the market that you know best, the market that you have the best connections in, where you've got the best relationships with experts. It's those sorts of things. What we have seen, though, is because the government changed the rules around the tax deductibility, we have seen a much more attraction for investors to new builds. And, we've seen across the last 4 or 5 years, record numbers of consents across New Zealand, particularly in those high growth areas, including around the Waikato. And you're seeing a whole load of intensification. So lots of townhouses, lots of duplexes, slowly some apartments. It would be great to see some more of those in Hamilton, I would say that. And both property investors and people looking to live in those properties are interested in those properties because they hit a different price point, but importantly, hit a different lifestyle point. And I think that when you're buying property for yourself or for tenants, people are making property decisions about their lives. The property, for the investor, it's about the property, but for the people that live in it, it's about the life they want to live. So different typologies are attractive to different types of investor, different types of tenants. And there is much, much more variety around now, which is a really positive thing for, the needs of New Zealand going forward.
Brilliant. All right, we're getting near the end. There's another question I'd like to ask you all before we wrap up, and I'll give us a closing round as well after that. So that's the property side. If we could invest in property, this is the inverse. If we've got somebody who couldn't invest in property, or at least they believe they couldn't, what would you advise they put their money into? It's a little bit like the opening question. What might you put your money into if you thought you couldn't get into the property space? You just couldn't make the leap, you didn't have enough. I might start with you, Billy Joe.
Yourself, education, one. That would be a biggie. So you can always get a master's and then turn it into something. MBA is really good. Good investment on that one. Otherwise, shares, but I would go to Stuart because, he'd put your money into a portfolio that kind of had global and local reach, as opposed to you going in, say, on Sharesies and going, oh, look, I'm going to invest in that tech company, and then who knows. So I think play the long game. Anything you go in with, play the long game. If you have an expertise in something or a passion, it might be umbrellas. Buy some umbrellas off Alibaba, sell them, put people's, like branding, just find a niche and find something. There's products that people need here in Aotearoa. You can start from there and go wider and become Container Door, who knows?
You've displayed your deep bias towards entrepreneurialism there. That's brilliant. Liz, what would you advise?
I would absolutely set up my own business if I couldn't buy a property. The key to wealth is leverage. If you're just an employee and trying to save out of your income, you're basically going to get nowhere, really. It's a long, hard graft. It is really important to do that as well, but if you seriously want to make a lot of wealth, you've either got to get big time into property or big time into running your own business. And I would have a serious think about that. It's not that hard to think of something that you can make money in. There's that many opportunities out there now. There's a lot of people that will help you. There's a lot of government funding available even. So why not give it a go? We are an entrepreneurial nation. Where I live I'm currently living in Kapiti, and we have a huge percentage of self-employed people here, and people who are running global businesses out of their back bedrooms. It's doable. Just think of something that really you do feel passionate about, you have an interest in, and and give it a go. But with that safety net approach I was talking about earlier, if you're not keen on that, if it's not for you, then I would invest in shares. It's got to be in a growth asset. You have to keep ahead of inflation. You're not going to do that by saving money in the bank. So it's got to go either into property, into shares, or into your own business if you really want to get ahead. You'll get left behind if you don't do one of those three things.
Good advice. Thanks, Liz. And Stuart?
Yeah, look, I think Billy Jo was talking to her 20-year-old self when she was saying that. I kind of felt like you were talking to me yourself many years ago about what you would do. So that was cool. But yeah, look, I think investing in growth assets is critical, and doing it when you're young is a real benefit. The earlier you start, not only do you learn more about investing, but you give investing the power to do its job, which is all about compounding returns over time. The tricky bit is when you're in your 20s, you don't really know what is ahead. And you might think right now, well, I'm never going to get into property. I'm not going to buy a house. So, yeah, you set up an investment portfolio or you go and start a business, but your situation is quite fluid when you're younger. So you should be in a position, if you're earning, you've got a job, you've got your career of earning ahead of you, to be as growth orientated as you possibly can and take the most risks when you're young, because you've got time to recover from them and learn from them. But you do need to constantly be just checking back in with yourself. We encourage people every year, no matter how old you are, to reassess your risk tolerance and your asset allocation. Has anything changed? Is anything coming up? Maybe in 2 years' time, suddenly you are looking at buying a house, and then you need to change what your asset base is to make sure you've got enough capital protected for your deposit or whatever it is. So, yeah, look, I think building on the answers beforehand, you should be going for growth, but you always need to sort of check what your situation is year by year.
Brilliant. All right, we are going to do a rapid fire last round question. So a short answer, and I want you to think that the goal of this is to build people's capability so they can go and take action, better action in their lives. What is a top tip that you would provide to somebody in order to grow their own wealth in the framework we said at the start? And it might be something, the best piece of advice that you've received, or it could be the tip that you wish you had got earlier in your career. But Roundtable, what's your top tip for people growing their wealth? I'm going to start with you, Jen.
I would probably say, there's an old adage in real estate that the best time to buy property is today and the second best time is tomorrow. And I think that the same is true about thinking about your financial future. The best time to start thinking about it and doing something about it is today. And so don't put it off. Start when you're young. It'll be worth it when you're 50, 60, 70. Brilliant.
Thank you. Billy Jo.
I would say if you don't have a deposit, budget. My big top tip is get that bottle of Mount Difficulty, and every party that you go to, fill it up with Reunite wine. No one knows. You turn up with that $40, $50 bottle that you'd save from your auntie's house and fill it up with the cheapest wine. Honestly, it's budget. Anything you can do to save money and make it a game. Know where every cent goes, and you will save that deposit. Seriously, it'll become every cent and every budget tips, and do it in a group. Find your tribe. Like when you start business, find your tribe. Find people who want to budget too, and fill up really expensive wine bottles with cheap wine. There you go.
Love it. Extremely practical. Stuart.
Yeah, look, I guess similar to the two previous answers, make a start. As I talked about in the previous answer, the jewel of investing is compounding returns. And how that works is the longer you're investing, the more you make. It's a snowball. And it builds and builds and builds. So the earlier you start, hopefully, the more you're going to make over a long period of time. So make a start, get some skin in the game, feel how it works and the emotions kick in. It's all a learning process. And on the back of that, talk to kids about it. If you're an adult and you're making a start, get kids involved, talk to them. There's a real lack of understanding about investments at a younger age in New Zealand. We don't do a good job of educating our kids at intermediate and high school. about property and shares and the world of investing. And if they had that knowledge base at that level, they would be in a much better position to make a start in their 20s and 30s when they're earning good money.
Yeah, great point. Thank you. And last word, Liz.
Okay, so over the last 20 or so years, I've spent a lot of time talking to people just, before the point of retirement, and the ones that have successfully built a lot of wealth over their working lives have had two characteristics in common. One is they have consistently spent less than what they've earned. In other words, been really good budgeters, always saved. And secondly, they've stayed out of short-term debt. That's credit cards, store cards, all that kind of thing. That's the key thing I would like to really drive home for people, is get into that habit of spending less than you earn. Because, money doesn't come out of thin air. You've got to have a deposit for something. You've got to have savings. You've got to have spare cash. You've got to have an emergency fund. The only way you're going to build up your reservoir is if you are spending less than what you're earning. And it doesn't take much. You can start out small, even if it's $10 a week, and just grow from there. But get into that habit of having some surplus and not going into short-term debt. Is just so vitally important.
Excellent. Well, look, I'll wrap up now. Thank you so much. Brilliant insights all around, a mixture of philosophical, psychological, and deeply practical, which is, I think, what we need for a topic like this. So thank you once again, Stuart, Billy Joe, Jen, Liz. I've really enjoyed the conversation. It's prompted me to do some thinking. I'm sure it will for many others as well. So we really appreciate your time and your expertise. So kia ora and thank you.